We have a few questions. The first one's from Martin Creamer, Mining Weekly. By what percentage will your renewable energy generation lower your dependence on Eskom electricity? And by what percentage will it cut your electricity cost? What other decarbonisation initiatives are being contemplated and or implemented?
The models we run, and again, on the initial 10 megawatts at Evander, we're not including any storage initially, because most of those solutions appear to be quite expensive, but you can sort of work on about 30% reduction in your power consumption and reliance on Eskom. And clearly, if we expand that, our intent would be to effectively have pretty much all of our group in South Africa run on solar during the daytime over the next 2 years or so. So you can assume then it will sort of reduce our power consumption and costs by about 30%. On other decarbonisation, the focus for now will be solar and making sure that solar works. And, 10 megawatts will be the first plant. And by early next year, it would have proven itself. The feasibility basically calculated that the payback on the capital is less than 5 years. At the Eskom current rates of escalation, it will probably be closer to 4 years. So that's the big focus for us now, is just getting our group to run off the grid, so to speak, during the daytime hours in the next 24 months or so.
Arnold van Graan of Nedbank.
Cobus, you talk about security cost and technology and things like that. Do you have a sense of whether your security cost at Barberton is on par with other operations? Not sure how you measure that, but let's say on a total percentage of total cost or on a per ounce basis.
Yeah, it's interesting. So to the extent possible, it's difficult to benchmark, but we have the benefit of liaising with all the other South African gold miners on a regular basis, and there's actually sort of a security forum that meets. So we've done benchmarking to the extent that we can, and we're quite comfortable that certainly our costs are not excessive. We do have certain peculiarities that I think some other miners might not have. I mean, an example would be, the incredibly high grade that we have on some of the areas at Barberton that necessitate specific security and gates, etc. So those are costs that potentially other miners would not have. Certainly in the year ahead, we will, as we said, look to engage sort of and have more technology-focused and based solutions so we can reduce that cost over time. But Barberton has been an issue with illegal mining for, as you know, many years. We're comfortable the issue is not escalating. Our security team is doing fantastic work. So yeah, we'll sort of keep certainly doing what we need to, and I think you can expect in real terms the cost to come down in the years ahead.
Next question is from Tim Huff of Peel Hunt.
On your costs, your guidance for next year is for sub 1200. It's a little bit higher than I expected, and I was just wondering if you could give us any guidance as to maybe the flexibility on that. Obviously, you guys have been doing pretty well on the production front, but I was wondering on the cost front, are there going to be any specific cost savings programs in the next year or even 2 years that start to drop costs from FY23? And then the second question was really just on Evander, just looking at the company's production profile over the coming couple of years. I see it lifting up towards 210,000 ounces, and I was just wondering, is a chunk of that expected to come from Evander, because the production profile doesn't necessarily say so, but between, I guess, the flexibility of the different operations and your run rate at Evander towards fiscal year end of this year, it looks like you've got some leeway there to hit production targets, which gives you some flexibility.
Let's start with the second bit first, if you don't mind. So, the big plus for us in 23-24, as we see it, is the forecast from Elikhulu. So currently, the test work we've done on Leslie Bracken, which is a new area that we'd be moving to, that'll allow us to produce more from Elikhulu. That's clearly a great benefit because, Elikhulu is an incredibly high margin asset, and it's going to reduce the unit costs on Elikhulu. And then, we do have some flexibility, we believe, to expand production on the Evander underground. So that's why you're seeing that sort of profile. And, I think we're trying to be fairly conservative even for FY22 with 195,000 ounces minimum, particularly given how we've started the year. So, we're quite comfortable with those targets. As far as the costs are concerned, if you recall last year, a big issue for us is the strength of the South African rand. So against certainly our expectations, the rand strengthened quite a lot. Last year, when we put out our US dollar cost numbers, we were using 16 Rand 50. Now we're sort of forecasting at 15. So, that's why you'd have seen the dollar costs go up. It's mostly a product of the exchange rate. I think in rand terms, we'd like to think we control costs quite well. The upsides that we believe is quite tangible, upside is certainly on expanding our solar footprint. So, that first plant at Evander will be up in the second half of this year. That'll reduce the power cost or electricity costs at Ilekulu by about 5%, or so it's a 30% saving on your total electricity costs. And we very much engaged with the feasibility at Barberton to construct a similar plant, and then obviously also expand the initial 10 megawatts at Evander to also cater for the Evander underground. So that, in our mind, should be a tangible cost benefit that comes through quite clearly in the next couple of years. Other than that, it's sort of producing more ounces and reducing your unit costs, and clearly we sort of will target whatever other efficiencies and cost savings that we can.
We've got a couple of questions from Mark Bentley from Share Society. First one is, when do you expect Royal Sheba to come into production? And what production profile do you anticipate once brought into production?
So, as we sort of indicated in the presentation, we're the first ore from Royal Sheba during this financial year, and we have about 2 to 3 years to then sort of ramp up Royal Sheba. And effectively, the idea is to replace the feed, as we said, of the BTRP and maintain the margins and the very attractive profits that we're currently generating at the BTRP. I think to some extent, we are very much spoilt with what we have at Barberton. Our head grade generally on the underground is 10 grams per ton. So this for us is a very low grade ore body. But the mining method that we will employ will ensure that it's low cost, highly mechanized. On the Royal Sheba uppers, there'll only be about 40 to 50 direct employees. So that'll ensure that we can sort of extract the ore at a decent margin and effectively maintain what we see currently from the BTRP from a profits perspective.
Also from Mark Bentley, it says, referring to page 31 of your summarized audited results announcement, what do the solar project liabilities represent, and why do they exceed assets / capex?
Thank you, Mark. The way the solar plant was funded was with a dedicated loan from Red Ink Rentals of circa 140 million rand, approximately $19 million. And this was drawn down as a single tranche to make it easier from an administrative perspective. It's a relatively small facility. And as we disburse to the contractor, we capitalize the costs. So at this stage, you'll see the loan exceeding the capitalized costs. The difference is represented in cash flow on the balance sheet. Once the project is completed on budget and on time, then the liability will equal the asset.
We've got a question from Gavin King regarding buybacks. What level of spending will your buybacks program be, and why choose a buyback instead of a higher dividend?
I don't think they're mutually exclusive. I think it's a question of making a call on whether buyback makes sense given where the share price is. I guess as most management teams, we feel our share price is massively undervalued. And I think given where the levels of projected cash flow generation is for the 22 financial year, there's no reason why we cannot do both, continue with our dividend, consistent with the policy, and at the same point in time embark upon a buyback where we do see the share price, just for sometimes inexplicable reasons, just losing a lot of value.